Good morning, everyone, and welcome. Now, just one moment because they're joining by now. Okay. So, my name is Daniela Crăciun. I'm Secretary General of CEE Perspective, and I'm very pleased to welcome you to the first event of our new Conversation with Experts series. For those joining us for the first time, CEE Perspective is an independent association working to ensure that the priorities and experiences for the Central and Eastern Europe are properly represented in European financial policy discussions. Through our academy, we organize monthly policy webinars, bringing together policymakers, industry representatives, and regional experts. We also publish regular analysis and a weekly newsletter, while our physical events give our community the opportunity to continue these exchanges in person. Conversations with Experts adds a new format to this work. These will be concise sessions built around a significant piece of recent research. We will invite someone directly involved in the work to explain the findings, take us behind the figures, and discuss what the results mean for the Central, Eastern, and Southeastern Europe. The latest EIB CESEE Bank Leading Survey is an excellent place to begin. It portrays a region that continues to inspire confidence, although not without hesitation. Households and businesses still want to borrow, and international banking groups continue to see CESEE as a place in which to grow. Banks, however, are becoming more measured about where and how they lend. Optimism remains, but is now accompanied by a closer examination of risk, credit quality, and the wider economic environment. That combination makes the survey especially interesting. It is neither a simple story of expansion nor a warning of retreat. It is more a nuanced account of a banking market that remains ambitious while becoming increasingly selective. As a Romanian myself, I am particularly curious about what lies beneath the regional picture. We often speak about CESEE as a single market, but anyone who knows the region understands how much can be concealed by an average. I look forward to hearing which developments are broadly shared and where individual countries are beginning to follow different paths. I am therefore delighted to welcome Matteo Ferrazzi, Principal Advisor and Senior Economist at the European Investment Bank and Coordinator of the CESEE Bank Leading Survey. Matteo will present the findings before we open the discussion to questions from the audience. Please send us your questions. You can have them in writing, and we will include as many as time allows. Today's conversation will be facilitated by Andrea Lungu, Lead Policy Expert at CEE Perspective. Thank you for joining us at the beginning of this new series. Matteo and Andrea, over to you.
Yes, thank you very much, Daniela. And Matteo, thank you once again for joining us and for helping us launch this new series. So rather than going through the report as a presentation, I thought we would make today's session a conversation using the survey results as a starting point. And I think there's quite a compelling story in the latest results. On one hand, we see that demand for credit remains strong in the region and funding conditions are favorable. And that international banking groups clearly continue to see CESEE as a region in which they want to grow. But at the same time, banks are becoming more cautious about extending credit. So I would like to start from that point in order to unpack it a bit further in the next 30 minutes or so. But perhaps, Matteo, before we get into the individual findings, could you briefly tell us what this survey actually allows us to see? So what does this bank lending survey tell us that we wouldn't necessarily see simply by looking at lending volumes or other banking statistics? Over to you, Matteo.
Thank you so much, Andrea, and thank you for the invitation, and also congratulations for this kind of initiatives. which are very welcome. So the survey is leveraging very much on the structure of the banking sector in Central and Eastern Europe. Why is that? Because there is, as you know, a very strong presence of international players. So we can ask a big number of questions to few players. And you know that international players are controlling almost 50% of assets in the region. And we ask them what do they think, and also to compare the different markets. So they can so also each subsidiary is answering. So we ask them how they have seen the market in the past 6 months and how they will see in the next 6 months. So we are able also to do some kind of forecast. And we ask mainly about credit demand, credit supply, and also about profitability, funding, and credit quality. What is interesting here, because you know that we can have data from the central banks about the trends in lending, which means we know that the lending is growing around 7-8% now in the region, so quite good. But we don't know if this is driven by the demand of the clients or the supply of the banks. So we distinguish of the credit demand that is reflecting the willingness of the clients to borrow, and the supply, so reflecting the bank's willingness to extend the credit. So that's the point why we ask questions on top of the usual data that we have from central banks.
Okay, thank you very much, Matteo. And I think this is a good basis to jump into the next question regarding, let's say, the most striking finding of the report. So the survey shows strong credit demand, particularly from households, while credit supply is becoming more cautious, especially for large companies. Could you walk us through a bit more on what is driving this divergence? And should we see it simply as banks becoming appropriately selective? Or do you think it could eventually become a constraint on investment and growth in the region?
Right, so this ability to disentangle supply and demand is quite interesting. So both of them were collapsing in 2022 after Russian invasion. We have seen country risk growing at that time, and then the situation stabilized very much in the region. We have seen in the last quarters very strong demand. So clients are asking for credit. And this was mainly driven by the recovery of investments, so very good sign from the corporate side, but also very strong, let's say, household market, especially mortgages. We know that the economic growth in the region is mainly driven by consumption, and also the real estate sector is very strong. So prices are up, there is a strong demand, and not enough supply. On the other side, the supply side of credit is a bit cautious. So we have seen banks that are on a neutral stance in the last quarters. So we have seen a sort of supply-demand gap in the last 2-3 years. And this is visible also from other survey, for instance, that they're saying that in Central Eastern Europe, there are a big number of clients that are still let's say we call them credit constrained. So they are normally discouraged, or they cannot access the credit. So there is quite a good potential to grow more in credit. And that's also the role of many financial institutions that are trying to facilitate credit in the region. We should not forget also that the region is also targeted for EU funds and for subsidized lending. So we see that this is higher in the region rather than in Western European markets. So just to summarize, demand is very strong, credit demand. Supply is rather neutral or weak, especially for large companies. So there is a good potential to fill this gap. So as you were suggesting, banks are rather prudent. So the attitude is that everything was fine until now, but they are not overextending credit. So I think also the experience of the previous crisis is playing a role in this.
Okay, thank you very much, Matteo. Just a quick follow-up question on my side. So specifically, if you could elaborate on the supply side, why specifically large corporates? And is this primarily about their risk profile, the economic outlook, as you mentioned, alternative financing options, or something else?
This is not emerging clearly from the survey, but my educated guess is that is mainly the international outlook. So the big corporations are more export-oriented. And of course, as we know, since a couple of years, export-oriented companies are rather nervous, as things are still going quite well. But, there is a little bit of different geopolitical environment that is affecting Central Eastern European companies. What we see is that Central Eastern European companies are really very export-oriented. So they're heavily affected from one side. On the other side, they're more export-oriented towards Germany mainly, but also other Western European markets. This is protecting them. So their direct exposure to the US is a little bit more limited, apart from some exceptions like Slovakia. It doesn't mean that they are fully protected, but for sure, the situation could be better than other markets. So that's my interpretation. So in this sense, we know that Central Eastern Europe is a really different bunch of countries from different degrees of financial intermediations development. But I like to still consider the region together to give an interpretation, because some trends are in common and they deserve a lot of attention. I always see that a lot of reports, analysis, Imagine Draghi competitiveness report, they're looking at Europe overall. So there is still need for analyzing the Central Eastern European perspective for companies, for banks, because I think it has peculiar trends. And imagine on competitiveness, the region is still growing a lot, so there is no decline at all.
Thank you. I would like now to move on to another topic on why banks are becoming more selective. And in this respect, the report identifies several factors weighing on credit supply. And this includes regulation, it includes expectations about credit quality and the global market outlook. So of those factors, which is currently having the greatest influence on banks' willingness to lend, in your view?
So I think the answers of the banks is mainly complaining on regulation. Since I look at this survey, is always regulation, and the general outlook, global and local outlook. So I think on regulation, here is typical complaint of banks, which is fair, because we have seen after the global financial crisis in 2009, a lot of additional regulation, a big burden for banks, big cost. On the other side, it's also true that we all know that, especially in the financial sector, regulation is still a very important anchor, source of stability. And so I keep this as a usual complaint, let's say, the regulation part. So I think it's normal for banks. There's a big burden and so on. There is room for simplification, for sure, but I think this will always stay there, this complaint about regulation. So the global outlook, the story is a bit different. Corporations, so I think that we are in front of a double-edged sword in this moment, a very peculiar moment. So from one side, there is uncertainty. Uncertainty is always there, but in this period is really high. And we have seen that the geopolitics was really invading the economic sphere. So economies are now looking at the geopolitical trends much more than before. So a lot of concerns from one side. From the other side, you see that corporates are very profitable. Things are going very well, and banks even more. So if you look at the performance of the stock market of banks versus big tech even, banks are overperforming in the last years. And it's even more the players that are in Central Eastern Europe, the usual names. Unicredit, Intesa, KBC, Erste, Raiffeisen, OTP, NLB, they are all overperforming the stock market. So things are going very well. Most of these players, they've seen their shares double, triple in the last years. So there is a sort of golden age for banks. I also like to see when they announce the results. So every quarter they say that this is the best quarter ever. So banks are really in a golden age in which they are. I like how they also present. So they normally say, despite The challenge is we have been able, they are suggesting, thanks to us, to do record profits. And this record profit is every time bigger and bigger in the last, I would say, 2 or 3 years, especially since the rates are higher. So they are mainly driven by high interest rates. So global uncertainty and very good situation. So the attitude of banks is very much like, so far so good, but let's keep prudent. We know that the crisis could come, turnaround could come. The economic scenario is unstable, and we create buffers. So capital is very high. Banks are extremely stable. There is liquidity. Shareholders are happy. So I would say it is a golden age, and the party is not over yet, I would say.
Okay. Let's now zoom out from the lending conditions to the broader strategic picture, because this is the most optimistic part of the survey. So more than 3/4 of the international banking groups surveyed plan to expand selectively in the CESEE region over the long term. And none indicate that they plan to reduce their presence. So building on what you have mentioned so far, can you maybe elaborate on what is driving that confidence, and has the region's strategic importance within the European banking groups changed compared to, let's say, 10 years ago?
Right. So we always ask not only about the short term, 6 months, as I was suggesting before, but we also ask about your long-term plans. So are you going to stay in the region? Are you happy to stay in the region? The answer is yes, we are very happy to be in the region. It's very clear. 3/4, they want to grow more. And no one wants to reduce. So there is not a single player that is answering to us, I would like to reduce a bit, which was happening in the past, maybe 10%, 15% in the past. They were saying, we need to streamline. So very optimistic picture in the long term. Which is the reason why? Mainly the reason is quite straightforward, profitability. So why they're happy to stay in the region? Profitability is not only good, but is higher than in their headquarters. So we ask them, are you happy about your subsidiaries in terms of return on equity, return on assets? We ask about risk adjusted, non-risk adjusted. We do a lot of questions. And they always say, our subsidiaries are more profitable than our business in Western Europe. And as I was suggesting before, the banking sector is in a golden age now. They're very happy in Western Europe as well. So you can imagine that in Eastern Europe, that's very good. So the situation is good because of mainly profitability. We also ask about market potential. How do you see the market? And they are also assessing mainly as very high potential. So the Central Eastern European story for banks is not over yet. And especially Czech Republic, Romania, and Slovakia, also Western Balkans, they always say it is more profitable on a risk-adjusted basis than in Western Europe. So it's not only a source of diversification, or they are there because they've been there in the past, but it's mainly because they're profitable, so they're bringing good results. So if we look at the recent M&A in the region, I think this is also very interesting. I wrote down because maybe I would forget some of them. So we have seen all the buyers that are the incumbents. So the main players in Central Eastern Europe, the CEE champions, are still expanding. So they're not only saying, but we see that they're expanding. So Erste Bank, for instance, the Austrian, was buying the Santander Bank Polska. So they entered the Polish market in quite a good size. In Romania, we have seen a lot of transactions. So Unicredit acquiring Alpha Bank. We have seen Banca Transilvania, that is a big player in Romania, expanding in the market. We have seen Intesa, that is doubling the presence in Romania, buying First Bank. And we've seen also Raiffeisen Bank, that will be the third player in Romania very soon after they are buying Garanti. So the subsidiary of Garanti, that is Banco Bilbao Vizcaya. This is only Romania and Poland. Then we have also operation of KBC, that is a very strong player in Slovakia, expanding. We have seen Addiko Bank, that is the Austrian bank, that was selling the subsidiaries of Croatia, Slovenia, and also Austria to Raiffeisen. So we have seen the usual names expanding. So the Central Eastern European markets are rather small, so the big players are looking for size. So we have seen, just to summarize, Erste, UniCredit, Intesa, Raiffeisen, KBC, top players in the region, expanding and buying additional subsidiaries. So I think the M&A market is moving. So there is big business in M&A. And we have seen the big players moving. So that's also a sign that is confirming our survey, let's say.
Thank you. I would like now to bring in the regulatory aspect a bit closer. So you've already touched upon this, but the survey identifies regulation as one factor affecting credit supply. At the same time, as we all know, there's now this broader European debate about banking competitiveness, as evidenced also by the publication last month of the Commission's report on this topic. And there's also a debate on whether some regulatory requirements make it unnecessarily difficult to move capital and liquidity across banking groups or finance certain companies. So from what you have seen within the CESEE region, can you elaborate a little bit more on how significant these constraints are compared to other factors that we've discussed?
Right. So as you were suggesting, regulation is always an important factor in banking, almost like in pharma, or very few sectors are so much regulated, and right so. And there is a debate about the European competitiveness. So this is broader, but also the banking sector is playing a role. And there is also the Saving and Investment Union initiative that is mainly thinking about the scale. So there are few players, few big players in Europe, especially in the investment banking environment. So just to give an example, the first American bank, which is JP Morgan, is almost 2 times the size of the top 3 EU banks. This is at European level. The top 3 banks are Santander, UniCredit, I think, and Banco Bilbao. So the JP Morgan is double the size. And JP Morgan is equal the size of the top 7 EU banks. So there is a lot of fragmentation in Europe if we compare to the US. This is not uncommon. It's the same in the energy market, it's the same in the telecom market. Maybe you have experience of traveling across Europe and your phone is having, if you travel across 3 countries, your phone is picking up 3 different operators. And in the entire US, you have 3 different operators, or 4 or 5, and for each European countries you have. So similar in telecom, you have an issue in banking. So the size is quite important. So there is a problem of scale, mainly. So that's what the regulation will try to address. We have seen not so many cross-border mergers. So if you think about the main mergers in the last years, the cross-border mergers are happening all in Central Eastern Europe. So the banking sector is very peculiar in this sense, because we have Western Europe that is a sector in which you have French players, mainly in France, maybe in a couple of more countries, Italian players in few countries. Then you have Spanish players in South America, not in Europe. Belgian players not going abroad so much. So the sector there is very much country-based. The size of the main country is maybe 80% of assets. In Central Eastern Europe, is completely different. There is already a sort of banking union. You have all the players that are present in many different geographies. So it's really much more mixed and international. That's a very, very peculiar. So the regulation would like to address the cross-border banking groups to manage capital and liquidity more efficiently. We are waiting for the legislative proposal that will be out in January 2027. So I don't have the details, but the idea is probably to favor the cross-border players. And I think this is what is missing in Europe, big cross-border banks. Why is that? Normally we address politics is very important, so there is a bit of control of political sphere on the local banks sometimes. But I think this is not the main reason. The main reason is that there are really borders, still borders in Europe. And banks prefer to be strong in their countries. They normally increase their size in their countries rather than going abroad, because the regulation is different, because it's hard to put together banks from other countries. So this is very important. We know that the European financial sector is having this problem of size, and also another problem of allocation of funds. So we call it lazy money. We have a lot of lazy money on the deposits. We are very prudent. We as Europeans, probably all of us, we are rather putting the money in the deposits. US citizens are normally taking more risk. They invest in the equity market and especially in the venture capital. So this is financing a lot of ideas. What happens? European money is going to finance the ideas, startups in the US. Many startups are moving to the US after the initial phase. And in Europe, we have a lot of very beautiful ideas that are then financed from the US, and then they move in the US. So that's another problem. So I think the Commission is trying to address these two problems with the Capital Market Union, and this will favor cross-border banks. I'm not sure we will see many of these mergers, but some of them will be there. I think a good example is now what UniCredit is doing with Commerzbank. UniCredit is already one of the top three players in Germany. So Germany is not a completely new market, but let's say an Italian bank buying a German bank is sort of news. This is not happening every day on in the other countries.
We also have, thank you very much for the remarks. We also received a question in our Q&A chat that I am taking the liberty to rephrase, but someone is asking if the concern is primarily around the regulatory, if you could elaborate a little bit on this, if the concern is primarily about the regulatory requirements themselves, or is it more about uncertainty around their interpretation and what would constitute sufficient compliance in practice?
Right. So I'm not an expert of the compliance issues. So in general, what I can suggest is a little bit about the trends I see at European level. So I work in European institutions. So there is a big wave of desire of simplification. This is happening in many different sectors. So most probably looking at banking, we have seen not enough regulation before 2009. We have seen the crisis. Then for 10 years, we have been following a different trend. So more regulation, more stuff on compliance, risk management, and so on. This was probably needed and good, but probably there are some parts in which we could see some simplification in the future. So I think it's always a balance, of course. It's not going only in one direction. In this case, if we look at this competitiveness of the banking sector, we don't have in our hands the real proposals because this will be published in January 27. So that's why I cannot exactly elaborate on the single norms. But in general, I think the idea is to let some simplification, especially for cross-border groups. So fine to see consolidation, Spanish banks buying Spanish banks, Italian banks buying Italian banks, Polish banks buying Polish banks, but it's also time to see some consolidation at the international level. And I can tell you this could be very beneficial for scale, but also for knowledge, because you exchange knowledge across countries and you create, let's say, a lot of feeling of being part of the same EU family. So it's a sort of Erasmus program of banking at the end when you do these cross-border mergers, because you interact with people from different countries. So this would be contrary to any, let's say, nationalism. Which is the problem? The problems are mainly crisis. When there is a crisis, there is no father of any bank. So if a cross-border bank is suffering, which is the state that is saving the banks if this bank is having subsidiaries in 20 countries? So that's the issue to be organized. The last, let's say, mini crisis we have seen was when we have seen Sberbank selling the branches immediately after the invasion of Russia in Ukraine. And so that time the risk was a bank run to the branches of Sberbank because, of course, this uncertainty regarding the sanctions and so on. And at that time, it was solved by the local players buying the banks. So this was solved in a weekend in which top players were acquiring the subsidiaries of Sberbank. This cannot be the normal setup. So we need, of course, a stronger way. So that's my feeling on what is going on regulation. But probably you will need to organize a full forum in January on compliance, if I can suggest your future.
There is another finding that I found particularly interesting, because there seems to be a recurring gap between expectations and outcomes. So, as we discussed, credit quality actually improved over the last 6 months, and yet banks expect it to deteriorate in the near future. Yeah, and as the report itself notes, similar expectations in previous survey rounds often didn't materialize. So why, in your opinion, the banks consistently seem to be more pessimistic about future credit quality than the eventual outcomes justify?
Yeah. So our survey, as I was telling you, is very useful to forecast the banking trends. And this was working beautifully. So on credit, on M&A, on the price. So it's always good in forecasting. The banks are constantly wrong when they suggest us the trends in NPL. So I hope there is some kind of prudent attitude. Or it means also they are working for the worst case scenario in case it is materialized, not the worst case, but let's say in a negative scenario, which is a good news. So they are, for instance, putting aside provisions for the bad times. So it's a very good time now. So they are always ready for these trends. But it's true that the banks are constantly forecasting a negative trend in credit quality in the last 2-3 years, and this is never materializing. So I hope they will be wrong this time as well, because they forecast both in corporate and retail a deterioration. NPL. So we were speaking about how good was the situation in the banking market in the last years, and the situation is also very good because of credit quality. So 10 years ago, the non-performing loans, so how many loans are non-performing out of total lending, were at 8% on average, with some countries like Hungary at 12, or of course, so 8 was the average. Then it went down even to 5% even during COVID. And then now it's below 3% on average, with just a couple of exceptions. All the countries are below 3%. So if we think in a profit and loss mentality, this means that in the last years, banks needed less provisions. So this is benefiting the bottom line of the profit and loss. So this was translating in a very good profitability. Are there risks? Yes, banks are telling us that there are some risks in commercial real estate and construction. The market is a bit tense. The small and medium enterprises are more exposed to trade, so they're usually more vulnerable, but even more in this period, and also consumer credit. So these are the 3 attention points in credit quality. Otherwise, we have seen very good trends as well in the last years and also in the last 6 months. So let's say so far so good again.
Thank you. Before we go on to the last question of our session, we have another question from the audience that you could perhaps quickly elaborate on. So what do you think are the main reasons for the higher profitability of banks in Eastern Europe compared to those in Western Europe?
Right. So let's again have in mind a profit and loss of a bank. I think the Central Eastern European banks, they have advantages across all the lines. So credit is growing more than in Western Europe. Margins are higher. So the interest rates are higher compared to deposit rate. Fees and commissions are similar, let's say. Costs are lower. Then as we were saying, also provisions are low. So if we do, let's say, lending revenues minus non-lending revenues, fees and commissions, minus cost, minus provisions, all these lines are contributing to the very good profit and loss. So that's why banks are still very, very happy. Of course, this trend is due also to the economic trends. You know that banks are mirroring the economies. The convergence process of Central Eastern European countries is still going well. So these countries are still growing by far more than in Europe, in Western Europe, or EU average, actually 3 times more. So we're talking about 2.5% of GDP versus 0 point something in Western Europe, especially, the German machine has been slowing down in the last years. We have seen some negative signs in GDP growth in Germany and Austria. Now it's better, but let's say the EU average is not so strong anymore. And the Central Eastern European economies are growing well. Still, it's true that this convergence process is slowing down gradually because, of course, it's closer to the target. So the banking sector is going very well because of all the lines we have seen, but the main reason is the very strong economic trends with Poland as a superstar, but also other countries are going quite well.
We've talked quite a lot about where the region stands today, so perhaps let's finish the substantive part of our conversation by looking forward. So looking ahead, where do you see the region's main competitive strengths and challenges? And what are the key indicators that you would watch over the next year to assess whether the region's positive banking outlook remains on track?
Right. So as we were saying, I think we need to look at two elements. First of all, the banking sector is mainly mirroring the economies. It's hard to completely have a banking sector that is going completely different than the economy. So I would look at the situation of Central Eastern European economy, a very good performance so far, as we have seen. The convergence process is ongoing, but we have seen some slowdown here and there. So what is needed there is an upgrade of the economic model. So some of the concerns are about higher salaries, high inflation affecting the competitiveness and so on. I see it not as black and white, but more as a transition. So sort of relay marathon in which you pass to other countries some tasks. Let's imagine the textile sector in 2 centuries ago in Great Britain, then moving to Europe, Italy, then maybe Slovakia, then Romania, Moldova, then Asia. So that's normal. This is part of the story. And this is happening on many other sectors. So there is a need of upgrade that this is happening, especially in the service sector. We have seen a very strong IT sector in Romania and Poland, in other countries, for instance. And then so first of all, Central Eastern European economies to look at. Second, I would look at the banking sector in general in Western Europe as well. So in general, so if you have a very strong banking sector as now, I think this will be a guarantee that the Central Eastern European banking sector will go very, very well. And that I was telling you is a sort of golden age for many banks, especially also the players that are in Central Eastern Europe. So these are the two elements I would look at. If we really want a KPI, of course, I would look at, the profitability of Central Eastern Europe compared to the group performance. So we were asking before why international groups are happy to be in the region because of higher profitability in the subsidiaries. The day that this will be completely reversed, of course, that's an issue.
Deo, before we close off, we actually have another audience question that I would like to quickly pose to you. It's looking at Germany, where corporate insolvencies have risen significantly. So given the close economic links between Germany and many CEE economies, do you see a risk of spillovers into the region?
Yeah. So as we were saying, we have seen a lot of weakness on the German economy in the last 2-3 years. So you may remember the last 2 decades where German economy driving everything, with South Europe rather weak. Now the trend is different, with the superstars in Europe are Spain and Portugal, and the German economy is weak. This is affecting other countries. So I would say I would not immediately compare Germany with Central Eastern Europe, because German economy was rather weak in the last years, and Central Eastern European countries were still growing a lot. So that's the good news. If you would ask this question, and by the way, thank you very much for the questions you are posting. If you would ask this question to the banks in our survey, they would answer that they will have immediate negative credit quality effects in the next 6 months. As we were suggesting before, they're always saying, I see quite dark in the next 6 months, this will worsen. So the answer to your question would be that they will see quite soon spillovers in Central Eastern Europe on credit quality. I'm much more optimistic, because the banks were wrong in answering this question. So I think we will not see a huge level of insolvencies unless we see a big recession in Central Eastern Europe. So I think this NPL level around 3% will stay for a long time. So these times of NPL at 10% are over. There's a lot of also managing NPL, prudent standards and so on. And also regulation was kicking in, and so a more prudent stance was taken by banks. So I think overall we will not see these big insolvencies. But my answer is different from the banks I'm interviewing, that they are much more negative. So anyway, Germany is for sure the market to be seen, because their success was built on cheap energy, was built on open international trade, on geopolitical cooperation, on defense allocated to the United States. So all these things are gone. So Germany is investing a lot in defense and other sectors, because the old model is over. It was very successful, but we need something else. And we know that Central Eastern European countries are very much attached to Germany. They are serving the German industries, especially automotive, but not only. So that's a variable to be taken into consideration for sure. And I would maybe suggest not to be fully scared if some manufacturing activity is diminishing, because we have seen in all the developed markets that manufacturing is eroded in favor of services. So let's imagine if car production will slow down in Romania and Slovakia, and the IT sector is growing. I think I would take it as a positive sign. It's not a disaster.
Thank you very much, Matteo. And I think that's a very good note on which to finish. It's been a really interesting discussion, and thank you for taking us through the findings and what they tell us about the outlook for banking in the region. Thank you as well to everyone who joined us and who submitted questions. And with that, I will hand the floor back to Daniela.
Hello, everyone. Nice to see you back. Thank you, first of all, Andrea and Matteo, for this very interesting debate. And I wanted to remind everyone that this is just the beginning of the series. We will come back in September, and we will have a special invite, a senior officer from the Council of Europe Development Bank, so stay tuned. Also, if you are interested in all our material, follow us on social media channels, namely LinkedIn, Instagram, or YouTube, and make sure to subscribe to our weekly, bi-weekly, and monthly publications that will really put a lot of effort into producing high quality and interesting facts. Thank you, everyone, for joining, and see you in another occasion. Thank you, Matteo. Thank you, Andrea.
Bye-bye.
Thank you.
Thank you so much.
Bye.